Hi everyone, this is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. I caught her great speech on the Mises Institute YouTube channel that was a couple weeks ago. She's a blockchain Bitcoin enthusiast. She's a pension settlement expert and a 22-year Wall Street veteran. Caitlin Long, thank you for joining me.
Thank you. It's my honor and pleasure to be here.
Now, Caitlin, for our listeners who are not familiar with your background, please tell my listeners more about your background on Wall Street and in the financial industry, and then how you found the Austrian School of Economics.
Sure. I spent a total of 22 years working straight in the heart of Wall Street for 3 different firms, most recently running Morgan Stanley's pension business. Left in 2016 to work full-time in blockchain. How I found Austrian economics was in 2012. I found Bitcoin in 2012. I found Austrian economics during the financial crisis. So it was fall of 2008 when I got very curious about contradictions in the mainstream explanation for the financial crisis that got me looking for better answers. And I did a big search of different schools of economic thought. I knew the mainstream ones were not correct, but I didn't know whether I would find an aha moment. And I did when I found the Austrian School.
That's almost the exact same way I found the Austrian School. I was working in the financial industry as well, although not on Wall Street. I was just a regular stockbroker trying to sell, mutual funds and bond funds during the 2008 financial crisis, and I wanted answers. And like you, I checked a lot of different sources, and there were a lot of people, talking heads, on CNBC and Bloomberg saying no one could have seen the crisis coming. And I was like, this doesn't make a lot of sense. I mean, there should have been some people who saw this with the warning signs.
Yeah, sure. And I kept in touch over the years with early clients from my equity research days and called one of them. Everybody was talking to everybody, trying to figure it all out and shed light. And I was working, right on a trading floor. So I did have access to the pulse, if you will, of what was happening, and not the actual information, but just the sense of how material it was. And one of my buddies called, and I asked him, what's going on? It seems like the Federal Reserve is at the middle of this. And he said, yeah, it is. And I said, I need to learn how the Fed works. And he said, start reading the Mises Daily Mail. And that's what got me going. And, I didn't have an aha light bulb goes off moment immediately. It took me a while because I was also getting feedback from others about, modern monetary theory and some of the more extreme Keynesian type schools of thought. But it was pretty clear once I looked at those that they weren't the answer. And, as you heard in the Mises speech I just gave 2 weeks ago, I think there are things about the Austrian thought process that should be updated, but there are more details on implementation of how the current financial system works than they are the basic approach. There's no question in my mind the basic approach of the Austrian School is what explains the environment that we're in right now and helps us understand the world around us so much better, how we got into this predicament and what's likely to happen as we move out of it.
Yeah, I agree. The Austrian School of Economics is by far the best of all the different economic theories about explaining what really happened. Although, it seems unfortunate, and I don't know if all the Austrian School people really understand all the details that the central banks are doing, but the rules keep changing. So, right now with current events with the European Central Bank and the Italian banks, I mean, if you would have went back and talked to some of the Austrian School economists back then, they would have predicted that, that would cause hyperinflation. And so they would have been wrong about that. But, a lot of this monetary inflation and the credit, you said in your speech, the credit, you outlined that there's been a lot of credit created that's like basically a money substitute. A lot of that monetary inflation, though, it hasn't necessarily gone into the real economy, although there is, I would argue, a lot worse stagflation in the real economy. But the majority of the monetary inflation since the 2008 financial crisis, and really, as you outlined in your presentation, really since the dollar went off the last vestiges of the gold standard in 1971, the majority of that monetary inflation has gone into asset prices.
Yes, that's right. And in fact, my mentor, to whom I gave credit in that speech for showing me the book, The Bitcoin Standard, he gave me some feedback from the speech. And a constructive piece of feedback that he had was, it's not correct to say that the Austrians missed hyperinflation. We are in a hyperinflationary environment right now, but they're not looking in the right place if they're looking for consumer price inflation, because it's showing up in asset price inflation, precisely as you said. And I think, again, this is where the Austrian school would do well to really dig in and understand the mechanism for that. And I pointed out in the speech, it really began in 1982, but wasn't well understood because it wasn't announced at the time. And it took years, really, it's only clear in retrospect, to see that that was a momentous monetary policy decision. And that was when the Fed stopped targeting M1 and started targeting the Fed funds rate. So in other words, it stopped trying to control the quantity of credit and just tried to control the price. And that's when they handed the proverbial keys to the kingdom to the financial industry, who got to control how much credit was created. And obviously, ever since then, it's just been a series of booms and busts, of financial market bubbles that are very strongly correlated to the acceleration in non-financial sector debt growth. And when that slows down, you get the economy slowing down. And, we just saw a GDP revision this week that corresponds to the fact that non-financial sector debt growth decelerated at the end of 2017. So it's not a shock that GDP growth decelerated in early 2018. And so, there are things you can glean that no traditional mainstream economic school would teach you from looking at the credit growth numbers. But it's just very clear that that the mechanism by which credit enters into the economy, newly created credit, is such that it stays in the financial system and makes the haves richer and the have-nots fall further and further behind.
Yeah, and since the 2008 financial crisis, I would argue that the major 5 or 6 central banks have created so much money in credit that they've actually accelerated and exacerbated the wealth gap. So they've actually made the rich richer.
For sure.
Yeah, they've made the rich richer, because if you already have assets, if you already have good collateral, you could have gone and borrowed money cheaply and bought more real estate, and you could have, expanded your bond portfolio and done sophisticated trades or made stock investments. I mean, look at the record margin debt for stocks.
Yeah, that's exactly what I meant by, making the have-nots have more. Those who have access to the newly created money and credit, i.e. those in the financial system, because that's where it comes into play. In the securities markets, there's still some credit creation happening in the traditional banking sector, but it's nowhere nearly the magnitude of what's happening in securities. So, it's not a shock that the hedge fund guys, have just created tremendous amounts of wealth. And are they generating value-added business in the economy? Let's put it this way. I don't think that if we had a true fair money regime that you would see those kinds of fortunes amassed in that way.
I don't think they're creating really any wealth for the real economy. I think what they've done is they've managed to financialize the economy more and more, and they've made fortunes for themselves trading very sophisticated derivatives and pieces of paper back and forth with each other so they can make more and more money. And, the financial system, Caitlin, and you could speak about this better than me. I mean, I've read books and interviewed a lot of experts, but the financial system has gotten more and more complicated and larger and with more and more leverage now, to the point where basically it's larger than governments can even handle at this point, because in 2008 the system basically collapsed, and then governments bailed out the banks, and now the governments have taken on the burden of those debts to keep the game going 10 years longer than most people thought. And, realistically, I think they should have let the banks fail. I think the bankers who committed fraud should have probably went to prison, and that would have sent a better message that they couldn't have gotten away with the stuff. And yet I don't think there's really been any lessons learned since the 2008 financial crisis.
Well, yeah, because there was still enough balance sheet left to reinflate the world. So I don't think that we were as close as again, the most pessimistic Austrians. There were some that did predict that the dollar would collapse after we went off gold. And I think what they missed is that the U.S. had a pristine balance sheet at that point in time. There was no net debt on our balance sheet. There was debt, but it was all backed by real savings. And so as we started to add net debt, beginning in 1968, it was a couple years before abandoning Bretton Woods, but of course it accelerated after that, and it really accelerated after that fateful decision by the Fed to stop controlling the quantity of credit and start controlling the price. That was when things really started to get out of hand, and it corresponds, if you think back in history, to the just incredible boom that we experienced in the securities markets. And so, a lot of folks along the way were predicting a dollar collapse. And I don't think we're that close to a dollar collapse. I think this can go on longer, and a lot of folks have been accused of crying fire in a crowded theater by calling for a dollar collapse. And that's the piece that I do think is constructive feedback to the Austrian School, is really digging into why it hasn't happened yet. It's not sufficient to just say, well, it will. I think explaining why it hasn't happened yet really is an important question to ask. And my interpretation is we still have balance sheet left. Our parents and grandparents and their grandparents bequeathed us a tremendous balance sheet. I was born in 1969, so right about at the time when that balance sheet started to be levered up. And as David Stockman calls it, we've done a national LBO ever since. And, there's still debt capacity on the books, but I'm not saying that the numbers that I shared in that speech are definitive, because I recognize there's circularity to that debt capacity analysis. There's no question that asset values, as we talked about a few minutes ago, are inflated. And when let's put it this way, the debt is contractual. It's very easy to know exactly how much debt outstanding there is, but the asset values are fleeting, and they can disappear if the credit bubble slows down. And so that analysis of the balance sheet of the United States, summing up all the individual borrowers and all the individual savers, which is what I did in that Mises speech, it shows why the dollar hasn't collapsed, in my humble opinion. But it doesn't really tell us how much more time we have. My intuition is that it's not imminent, but I also shared some numbers that would seem to explain that when that correction comes, it's really not going to be pretty.
And I think there's also a couple other reasons, too, for why the dollar hasn't collapsed. I mean, there's 5 or 6 other large central banks trying to do the exact same thing that basically the Federal Reserve has been doing since 2008. So there's, all the major economies are kind of using the same Keynesian playbook their central banks are, where they're trying to devalue their currency to boost exports. They don't want to pay their unfunded liabilities in real terms. And they look at the amount of debt that these major governments have loaded onto their balance sheets since the 2008 financial crisis. I think it's over 200% increase in debt since 2008. So it's just an enormous amount. The other thing is the way the global financial system is set up, the U.S. is able to export those dollars. So those dollars don't stay in the U.S. real economy. They're exported when other countries, produce goods and services. They earn dollars. And for many years, they held on to those dollars. So they bought treasuries with them, or they just held the dollars in cash as reserves. So I think a lot of Austrians, as right as they are about certain things, maybe predicting like the housing bubble coming like Peter Schiff, or the Ludwig von Mises saw the 1970 stagflation coming before he passed, and he also saw the 1929 crash too before 1929 crash. And if you read a biography about von Mises, he intentionally didn't take a job it was either a German bank or an Austrian bank, Credit von Stahl.
Austrian, yeah.
Yep. So his wife wanted him to take this high-paying job as the chief economist at one of the banks, and he refused because he saw that the bus was going to come after 29. So I think Austrians, they like we've discussed a little bit earlier. I think they understand by far, compared to the other economic schools, the Keynesians, the socialist Marxists, the MMT people, the monetarists, they get things better. But, the whole system has stayed together, I think, in a lot because of, the rules changes and then just more quantitative easing and bailouts. And so I think that's something that the Austrians did not see, was that the rules would change, the people in power, the politicians and the central bankers would just routinely like look at the ECB, right? I think about 8 years ago, Caitlin, you can correct me if I'm wrong about this, the European Central Bank wasn't even allowed to do QE. I remember seeing interviews when I was starting to learn about investing in finance saying the ECB will never do QE. It's not allowed in their bylaws. And then look, here we are. The ECB almost has $5 trillion on their balance sheet from bailing out their banks and delaying, these bank collapses.
Yeah, I'm not familiar with that, but I can say that yes, the mechanisms that you pointed to are accurate. What's missing in all of this is an understanding of the balance sheet. Where did it come from? Why is it that the currencies haven't collapsed yet? And implicitly, the reason the currencies haven't collapsed yet is that there's still debt capacity on the economies. And I've done the math in Europe and in Japan, and actually, surprisingly, the Japanese situation, I haven't updated it in a couple of years, but Japan has deleveraged so much in its private sector. What you read about in the public sector is very misleading because, yes, the government has ballooned its debt in the last 20 years. But in fact, actually, since Japan had its collapse in the early 90s, the private sector, both businesses and households, have massively deleveraged. They've paid down tremendous amounts of debt so that in aggregate, there's not that much incremental debt that's been added to Japan's economy. So if you read the mainstream, you think Japan's a basket case. And in fact, actually, I think it's a perfect example of why the mainstream folks have been so off. There's a fundamental reason why Japan hasn't collapsed yet, and it's because the private sector has been deleveraging, although you'd never get a Keynesian to admit that. What I think the elephant in the room is the place where we can't do the balance sheet math because there's just not enough information disclosed, and that's China. I think if China hadn't opened itself to the world 20 years ago, 25, actually now closer to 30 years ago, that we really would not have had the ability to continue to keep this going for as long as we have. And the accumulation of debt on a country's balance sheet has never happened faster in the world than it happened in China. We know that intuitively. We can see it in the numbers that they do disclose. What we don't know is how much balance sheet capacity is left. Keep in mind, China was a country that had no debt on its balance sheet, and it had tremendous capacity to generate income, as we've seen. But it needed, of course, to open itself up to the world in order to do that, and it did. But when it did, just like the U.S. in 1968 had no net debt on its balance sheet, China had no net debt on its balance sheet when it opened itself to the world. So how much more balance sheet capacity it has is an open question. Europe, on the other hand, is the place where I've always thought you're going to see when the granddaddy of them all comes, it's probably coming in Europe because Southern Europe has been out of balance sheet for a while. They were almost out of balance sheet when the so-called PIGS countries joined the euro in the first place. They got a lifeline thrown to them by Northern Europe, who had much stronger balance sheets. And so when you put the two together, that buys Southern Europe time to continue to be profligate. But there's only so much balance sheet in Europe. Germany and the Netherlands can only carry so much of Southern Europe. They're only, give or take, a third of European GDP, right? So Europe is where I think ground zero is going to be. But I must admit that, as you said, pretty much everywhere in the world is over-leveraged. There's one country that I find absolutely fascinating that is not over-leveraged and has actually been going the opposite direction. And if you understand its history, you understand that its history is very counter-cyclical to the rest of the West, in particular, the Western world. And that country is Russia. And the fact that it's been cut off from the global financial system for much of its business is ironically is actually going to have helped it when you look back in history, 10, 20 years from now. The fact that it was not able to borrow in the Western capital markets and accumulate debt. And in fact, actually, as some of your audiences may have been reading, the Russian central bank has been buying gold right at the time when all the IMF and Keynesian economists were telling it to sell its gold to support the ruble. They just let the ruble float. a few years ago when it was under pressure, and in fact actually went in and bought gold. So very interesting case study of countercyclicality there.
Yeah, the macroeconomic situation is very interesting. The Chinese data I've seen is that the People's Bank of China has like around 220 trillion RMB on their balance sheet, and in the last 12 months they've created $6 trillion US dollars worth of credit in their real economy. So, the records that they're setting, there are red flags there. I don't want to predict an imminent collapse, but in probabilities, I agree with you that Europe and China are probably the most likely to have economic problems in the near future. I think, a lot of people in the alternative media and the gold community, a lot of Austrians thought the US was going to be the one that had the problems first. But I think, for some of the reasons you said and some other reasons that we didn't mention, that the U.S. probably will be saved for last to deal with, its unfunded liabilities and all the other problems.
Oh yeah, and if you've ever read the book When Money Dies, the thing that I took away from that book, by the way, I highly recommend it. It's the history of the hyperinflations in Germany and Austria in between the two world wars. What I took away from it as a financial markets person is just the incredible swings that took place as the currency was dying especially 2 years before it actually died, but the amplitude of the swings was accelerating, and the period of time in which those swings were happening was shrinking. You can't see that on if you just looked at a simple exchange rate graph where what it looks like is just a complete collapse of the currency as the hyperinflation hit. You have to actually look at different sub-periods of time to realize that there were 50% daily swings in the exchange rate relative to the French franc. And the stock market volatility in Germany was staggering. You'd see, 75, 80% swings in a single day. So as I think we should expect that this period of relative calm, of relatively low volatility in financial markets that we've experienced is not the norm. And, what's likely to happen is periods of extreme volatility precisely because the whole financial industry is so unstable. And we're going to see those extremes. And I think we should expect that. And the mechanisms, again, are very different. If you read the history of the German hyperinflation, it's not going to play out exactly the same way, but history does rhyme. And I think the directional conclusion that's worth understanding is just how volatile those markets came at the end.
Yeah, I agree about volatility coming back. For the last few years prior to 2018, really, there wasn't a lot of asset price volatility. The stock market basically went parabolic and didn't really have even a 1% or 2% correction for, I think, over a year. So now we're starting to get that volatility back. And, that's normal. I think that's normal. The people who were used to the stocks only going one direction and, the upward price volatility, that's the good kind of volatility, that's not normal. But, a lot of people, they want to buy the dip, they want hopium, they want easy money to be made, and they're going to learn the hard way that that's not how the stock market works. So let's transition now to Bitcoin and the blockchain. So how did you find Bitcoin? When did you find Bitcoin and blockchain? What do you like about it?
Well, it was impossible to avoid it in Austrian school circles. I was a regular reader of everything that came out of the Mises Institute in the Daily Mail, Cobden Center, from sort of late 2008 through really today, but especially back then when I was trying to absorb so much and learn coming into it new. And, I went to Mises U several times and Austrian Scholars Conference, a very large number of Mises circles and started to support the Mises Institute now more than 10 years ago, but also see Cato, Reasons, other places as well. And it was impossible to avoid Bitcoin. I definitely remember reading about it in 2012, and I also definitely got my first Bitcoin wallet in February 2013. But I'm sure I read about it sooner than that. I just didn't understand it and ignored it. A lot of people did, and especially in the Austrian world, a lot of people did. But I started to see people like Jeffrey Tucker start talking about it. And, when somebody of his caliber says, hey, you got to pay attention to this, that made me pay attention to it for sure. And he put out a how-to, how to set up your Bitcoin wallet in, I believe it was February 2013, and that's when I did it. He was up at Liberty Forum in New Hampshire at that time, and he even had a blog post about using a Bitcoin ATM. I didn't even know at that time that such things existed. So I dug into it, and like so many people early on, I just dipped toes into it. I made a lot of mistakes. Charlie Shrem has had a tweet that I love. It's one of my favorite tweets of all time, which is the best way to learn how to make money in cryptocurrencies is to lose it first. And I lost some. I lost some in Mt. Gox because everybody was using Mt. Gox back then, and I didn't fully understand that was, if I didn't own my private keys, I didn't own my Bitcoin. I just didn't understand enough of it in those early days, and there was so little written about it back then. It just wasn't easy to figure out. But I took the time, and like everything in life, if you invest personal time in it, you're going to learn. And this is one where there is no substitute for investing personal time. There's plenty out there now, so much more than there was 5-6 years ago, to teach yourself how to do this. And I would strongly suggest that you learn from my mistakes, learn from the mistakes of everybody, and teach yourself how to keep your own private keys. And in fact, actually, if you're so inclined, run your own Bitcoin node, because if you're not running a full Bitcoin node, you're relying on others to confirm your transactions. And if you truly believe in self-sovereignty, you need to be able to confirm your own transactions on your own.
Yeah, my story about Bitcoin is actually a little bit different. I actually have known Trace Meyer since shortly after the 2008 financial crisis. Before he ever actually bought a single Bitcoin, he was releasing this ebook called The Great Credit Contraction, and he was just he had just created the website like Run to Gold, How to Vanish. And so, I was interviewing him on my podcast here for years, up until Bitcoin came out. And then he was obviously one of the first big name people to start buying a lot of Bitcoin, and it was under $1. And he was trying to explain it to me. And I have a finance background like you. I do not have a technology background. And he was trying to explain it to me, and it was just totally going over my head. And as you know, like a lot of people with investing, you do not want to buy something that you do not understand. So I started interviewing Bitcoin experts. I started reading Bitcoin books, but I was not comfortable buying it. And so I waited a couple years, and then in 2000, Bitcoin had already gone up to like $1,000 a coin and then crashed. And then unfortunately, my former business partner, he told me that he had bought 10 Bitcoins with some cash in one of our business accounts after it had crashed in 2013 from 1,000 down to 100 something. And then I found out, and this is one of the reasons why he's no longer my business partner, that he didn't buy the 10 Bitcoins. So.
Oh, no.
Yeah.
Wow.
Well, you live and you learn. So as the story you said about like making mistakes in Bitcoin, I think that also applies to stocks. So I've listened to a lot of great investors talk about, how they started investing in stocks, and a lot of them that made a lot of money on their first stock investment or stock trade, they got filled, their ego got filled, and they got too overconfident. So I think it's important then to maybe probably not have good luck with your first investment then, because it'll lead to, especially with options trading. I mean, I've interviewed a lot of people over the years, and I've spoken with consulting clients, and the ones who have touched options trading, they don't have any financial background, and they try to get rich quick on an options trade, put way too much money in like at a casino, and they lose all their money right away.
Yeah. Well, I the advice I'm giving doesn't have to do with trading and entry points in cryptocurrencies. It more has to do with the operations, how you ensure that you actually own your assets. And then one of the problems with stocks is that you actually don't own your assets. What you own, just like with your bank deposit at your bank, you own an IOU from your financial institution. Your bank deposit is not yours. What it is a contractual obligation by your bank to pay you if they can. And that's why you're exposed to bank runs when you put money in the bank. You have legally lent your bank, your money. You don't own it anymore. You just own an IOU. The same thing is true with stocks. You don't own the shares in your brokerage account. You have an IOU from Schwab or Morgan Stanley or Merrill Lynch or whomever you're using. None of us own the stocks in our brokerage accounts. Unless you own the paper certificate, you don't own that asset. What you own is an IOU. That is a form. It is an asset, but it's a form of shares, but it's not the actual shares. So the great thing about Bitcoin is you can own your own asset, but you have to take responsibility for it.
Yeah, I was going to add to your point there about not owning your shares. I've learned about, having to have your shares registered and trying to get a share certificate. A lot of brokers won't even do it anymore. So you have to jump through a bunch of hoops. Yeah. You have to talk to multiple customer service people, get passed up the chain to middle management and upper management. And then you're looking at over $500 in fees to direct register your shares. And, part of that process, I think you talked about this in your presentation, is that there's a lot of, let's say, inefficiencies and a lot of middlemen on Wall Street there who take their cuts of things with the DTCC and others. And you were talking about how you think blockchain is going to fix this on the stock exchanges?
Well, yeah, in the sense that you can take control of your own assets. It's going to take a long time because let's put it this way, there are a lot of people who now have figured out how to arbitrage the delayed settlement on Wall Street and take advantage of the fact that the accounting systems on Wall Street are not in sync with each other. It's the reason that the accounting systems on Wall Street are not in sync with each other is really twofold. It's delayed settlement and layers of intermediaries. So the reason why we settle stock trades T+2 has nothing to do with technology. It has everything to do with the fact that the trades have to go through a sequence of intermediaries, and up until 5 years ago, maybe more like 10 years ago, those intermediaries were all batch processing their transactions overnight. So you had to wait until it cleared one institution, and then the next night it cleared the next institution, and then the next night it cleared the next institution. And when I started in the stock market in the mid-90s, 1994, it was T+5, and then it was like pulling teeth to get everybody to go to T+3. Now we went to T+2. That long ago stopped being a technology problem. So why are we not at same-day settlement or even intraday or even real-time settlement? We have the technology to do that. The reason we're not is because there's a whole lot of folks who now make money at this. Some of it nefarious, but I don't think unless we change the market structure to remove these intermediaries that we will ever get to a T+1 settlement on securities. It's just, there are just too many intermediaries involved.
For listeners who are curious about this, besides your excellent presentation, Caitlin, Patrick Burton also did an in-depth documentary about this a few years ago, talking about, I think it's Through the Looking Glass. He got in trouble with Wall Street for shining a light on this, about all the fraud and how, they counterfeit shares, they make it short, they failure to deliver, things like that, the games you were talking about. Yes.
You should not trust your brokerage statements. I do not. There's a lot that goes on behind the scenes in what's called omnibus accounts. And those omnibus accounts are not audited in the same way that your personal brokerage account is.
Well, I think after interviewing a lot of different experts, Caitlin, in different fields, whether it's high-frequency trading, I even interviewed Helen Davis Chapman, who was a victim of the Madoff Ponzi scheme, and Bernie Madoff even called her, trying to hire her as his lawyer. So I just assume basically that in Wall Street and the financial sector that there's going to be pervasive corruption and fraud now.
Well, it's not. Yes, it's pervasive, but it's not easy to detect. The Dole Food case is a very interesting one, because the fact that I have not yet heard any regulator prosecute anyone tells you that there is something wrong with the enforcement arm of Wall Street, Justice Department, SEC. I'm not sure where, but by now we should have heard of somebody being prosecuted. And here's what happened. There were 36.7 million Dole Food shares outstanding. There was a class action lawsuit relating to an acquisition of the company, Dole Food, and there were 49.2 million claims filed for the 36.7 million shares outstanding. And so Wall Street's accounting systems created 12.5 million real claims that were reported on people's brokerage statements to phantom Dole Food shares that did not exist. So what happened there, the lawsuit judgment, the opinion, has a lot of detail. And 10% of the problem was naked short selling, which, again, is illegal. And I have not seen any announcement about enforcement action by the SEC against that. It should be easy for them. There it is in plain English in a Delaware court opinion that it happened. And then the other 90% is just straight outright fraud in almost all circumstances, most likely. And what happened is you have a lot of merger arbitrage hedge funds who figured that they could probably double dip and get away with it. And guess what? They probably did. And this is good old-fashioned fraud. The SEC, or the Justice Department should be going after this, but I have not heard that they did. And in fact, actually, I made the same speech at an emerging frauds conference at the Justice Department about a year ago. The opinion had just come out of the Delaware Chancery Court in February 2017. There it is in black and white. So this is clearly a new type of fraud. My intuition is that it happens in every M&A situation. It's just usually not that big of a fraud. And it had to do with the fact that we were on T+3 settlement at that time. And what happens mechanically when a company is acquired, the stock certificate has to be delivered to the buyer at closing. But if it's a publicly traded company, all of the trades in the last 3 trading days, because we're at T+3 trading back then, are going to close after the stock certificate has already been delivered to the buyer. So now we're on T+2, so now it would be only the 2 trading days before closing. But back then it was the 3 trading days before closing. And so what happened is you had a lot of merger arbitrage hedge funds who knew they sold the shares in the final 3 trading days of closing, but it still showed up on their brokerage statement that they owned them, so that when there was the class action lawsuit, they could file a facially valid claim for that class action consideration. So they stole money from regular old shareholders of Dole Food. And I think this happens in every merger situation. And I just, it's just usually not big enough to detect. But anytime there's a class action involving appraisal rights in an M&A situation, this is going to happen. And it's because the accounting systems on Wall Street get out of sync with each other. And I think in that case, there were a lot of nefarious actors who knew that they could get away with it and most likely did.
I also think that high-frequency trading systems are not beneficial to people, and they don't provide liquidity like the claim is. I think they're basically just tools for market manipulation. They create extra volatility that should not be there. It's artificial. And then they basically illegally front-run and scalp regular people's trades. So that's my opinion. But the regulators won't prosecute any of this because one of the former CFTC commissioners who spoke out against high-frequency trading, he just got hired in the last year or so. He left the CFTC, and now he's a highly paid lobbyist on behalf of the CFTC industry. On behalf of the high-frequency trading industry.
Oh, interesting. Yeah, I haven't followed that. I suspect that there are nefarious things happening. But to me, that's not quite as black and white because, if somebody can get a trading advantage by putting their servers 1 inch from the New York Stock Exchange, Godspeed. In a free market, they figured out how to execute better than their competitors. I don't have a problem with that. But what I do have a problem with is the accusations of outright front running, where the so-called Chinese walls between the customer order flow and the broker-dealers are sieves. And I know that this kind of stuff is happening. I know, working in the fixed income area of Wall Street, that, there's a cadence to this, right? At 2 o'clock, all the bond deals price for the day. Well, the head of capital markets will have a call with the trading desk to talk in generalities about what kinds of volume is going to be pricing for the day. he can't say anything about who's pricing it. But here's the way the market works. If somebody's going to be issuing a 30-year bond, the mutual fund is not paying for that in cash because they all have duration targets that they have to manage. So that what they'll do is just sit on 30-year treasuries, and they'll swap their 30-year treasury for the 30-year corporate bond. So essentially what that means is there's a big trade coming in the treasury market and also a big interest rate hedge coming in the treasury market. So it almost doesn't matter to the treasury market trader to know whether it's Procter & Gamble or Johnson & Johnson issuing the bond at 2 o'clock. All they know is there's a big 30-year corporate bond coming at 2 o'clock, and that enables them to get ahead of that volume in the treasury market. And the SEC has investigated things like that, and I've not seen any enforcement action. Again, I think some of these actions are subtle, and you can't directly tie them to specific front running. But they're there, no question. And in a truly free and fair market where you had sound money underpinning it, none of these things would be happening.
Yeah, I agree. If money was sound, there would be a lot less fraud and corruption, and banks getting away with a lot of different, let's say, accounting tricks or figuring out ways to cheat the system or cheat their customers. If you're interested, for our listeners out there, Eric Hunsader from Nanex, he tracks high-frequency trading charts to the nanosecond, and he shows the algorithms in nanosecond charts with manipulation algorithms and then front-running trades. So I don't want to spend too much time on that, but you can check out his work, and he shows with proof that a lot of different markets and some of the same trading patterns occur throughout on different days of the week at exact same time. So it's pretty striking, the coincidences. So last segment before I let you go. So, with blockchain, some of my listeners out there, they're hardcore gold and silver bugs. They like the Austrian School of Economics. They believe in freedom. But with Bitcoin and blockchain, they're worried. So they're worried about governments taking this technology that could potentially, I'm not saying they're definitely going to do it, but I know at least governments are contemplating it, tracking and taxing every single transaction, potentially banning cash. There are some academic economists like Ken Rogoff. He wrote a book, I think, in November 2016 called The Curse of Cash. He wants money banned. In the European Union, they're talking about banning paper money as well. So do you think then, Frederick Hayek talked about denationalizing money, allowing the free market to work. Do you think that blockchain and cryptocurrencies can potentially do that? Or do you think that basically it's a race that the governments are going to really work hard attempting to hijack the technology and, enslave us further, track and tax every transaction, ban cash?
No, I think they are going to track every transaction from a tax perspective. We should expect that. But by the way, in my native state of Wyoming, we passed 5 blockchain bills in the legislative session in February, one of which exempts cryptocurrencies from the money transmission laws, another of which exempts cryptocurrencies from property taxes. They're already exempt because there is no income tax. They're exempt from income taxes. And our task force just got together, and I got passed unanimously on the task force recommendation to make cryptocurrencies legal tender in Wyoming. And gold and silver specie are already legal tender in Wyoming. So effectively what that means for a tax perspective is that they can't be taxed. No sales tax would apply to them. So that last bill hasn't passed in Wyoming yet, but boy, would that make it interesting for all crypto investors who are American to become Wyoming residents, which a lot of wealthy people already have because it's such a friendly tax environment. But yeah, I mean that's where the governments are going to get it. They can't shut the technology down. They can't hijack it. They can implement their own versions of it, and they will, and those will help take efficiencies out of the system. There's a lot of redundancy in record keeping, and a blockchain enables multiple parties to share the same data at the same time and trust that it's valid. And so there are going to be a lot of blockchain-inspired technology efficiency gains where you get institutions coming together on these private blockchain networks to share infrastructure. And that's great. I have no problem with that. But in terms of value transfer, the more decentralized the network, the better it's going to be. the greater the network effects, the better that money's going to be. And frankly, the more expensive it is to produce the money, the better that money's going to be. And there's really only one true blockchain in that regard, and that's Bitcoin. There are some challengers, and I have no idea which ones of those challengers, if any, will ever overtake Bitcoin. But it's certainly it's very, very special, and I find it fascinating that a lot of Austrians haven't come around to it yet.
Well, I think diversification is important. So we don't know what the future is going to be like, how the rules are going to change, what the central banks or the politicians are going to decide to do going forward. I mean, only probabilities. So I think it's important to diversify and, own some Bitcoin, own some gold, own some silver. One of the reasons I like Bitcoin is because it's hard to produce it with the algorithm. It's made hard to produce. It's made to basically be a version of digital gold. Gold and silver are extremely hard to mine, extremely hard to produce.
Yeah, and so is Bitcoin. It's extremely expensive. And one of the things that the Bitcoin Standard, which is a book that I think all Austrians should read, one of the things that I learned from reading that, and keep in mind, I've been around Bitcoin already for 6 years, he talked about the difficulty adjustment, which is how miners solve the math problem. That math problem gets more or less difficult based on how much demand there is in the network and the price of Bitcoin. So it's moving up and down by algorithm. And what that means is that it's never going to get easy. It's never going to get cheap to mine Bitcoins. We don't know definitively that it's never going to get easy to mine gold. Somebody may discover a gold seam somewhere that might cause the price of gold to collapse. But in Bitcoin, definitively that that's never going to happen because the difficulty adjustment always makes it such that only one block is mined every 10 minutes. And so therefore it's never going to be cheap and easy to make more Bitcoin. And needless to say, you can't change the number of Bitcoins anyway. It's algorithmically fixed at 21 million. But I actually have in front of me the quote that I love from this book. Difficulty adjustment is the most reliable technology for making hard money and limiting the stock to flow ratio from rising. And it makes Bitcoin fundamentally different from any other money. As more and more people come in and demand it, it gets harder and harder to produce. It's just brilliant.
Yeah, there's a lot of interesting components that went into Bitcoin that Satoshi thought about. So I think in your presentation, you talked about how he put economic incentives for people to mine blockchain and protect it from being hacked. So in addition to, solving the algorithms and actually, doing it's in combination with game theory. So it's a nice mix. Yeah, it's a nice mix of things that a lot of people, they just say, oh, it's a stupid algorithm. And someone else, a lot of people hate Bitcoin are like, well, it's not physical. They don't understand that they should have some for diversification purposes. And then they say, oh, it's a stupid algorithm. Someone could hack it or someone will just copy it and make other algorithms. Well, no one has the network then.
Yep. Yeah, that's right. It is truly the only decentralized currency, and I think it's when I say decentralized, I'm saying that in the context of denationalized currency. There are more than 10,000 nodes all around the world running the Bitcoin network, and the Blockstream guys who employ a lot of the core developers who keep the Bitcoin code, open source code, up to date. They actually went out and got satellite capacity. That's just the way they did the satellite capacity is also brilliant. Nobody's ever going to be able to shut it down. So even if the ISPs shut down the wires in the U.S., the Bitcoin blockchain will continue to go as long as somebody's got satellite access anywhere in the world. So
yeah, I've heard the argument that the only way the government could shut down Bitcoin would be to shut down the internet too. But I mean, governments love the internet, so it's easy to spy on us and collect our information, right? So
yeah, that's why I think that the tax piece is going to be the big one, and don't be afraid. Don't be. Everyone should expect some major tax enforcement actions coming in this area. It's also true that it's pseudonymous. It's not anonymous. And so, like you said, unfortunately, and Edward Snowden actually said this. This is the downfall of Bitcoin: is that ledger is actually itself public, So you can go and see, it's like a ticker tape. You can go and see your own transactions. And that means that big data folks can come and aggregate who owns what. And so there is a race to add additional privacy, but everyone should expect that the IRS has access to all of that aggregation of information, and they're going to be coming after folks. So yeah, it's the SEC crackdown on the frauds in the initial coin offering market has garnered a lot of attention, but I think we're going to have a tax crackdown fairly soon as well.
Yeah, they've just been going after the exchanges for customer names right now. I know in South Korea, because the South Korean crypto exchanges were anonymous, the South Korean government forced a shutdown for a couple days to make public, eliminate the anonymity then of the customers. So the main reason that the South Korean government, they didn't want to eliminate cryptocurrency trading, they just wanted all the tax information public so they could collect capital gains taxes. That was the main reason. But I think, Caitlin, I've studied a lot of history, and the one thing in common, no matter how far you go back, is that whatever the market has decided to be money, whether it's seashells, gold and silver, salt, governments have tried to basically hijack it. They want control of the money supply. Because that gives them, more power, more ability to cheat, more ability to, expand welfare, warfare state, etc.
Yeah. It's but again, that's what makes Bitcoin so special. It can't be hijacked. So therefore, it really is in a different place, and it is quite unique from I hate the word, putting any adjective in front of the word unique. It is unique. Factually, it is unique. There is no other money that can be so out of government control where the stock to flow ratio can't spike because of the beautiful balance that Satoshi created between the technology and the economic incentives.
And I hope I'm wrong about this, but, governments, like you said, because I don't think they can really shut it down without shutting down the internet, but they can call, anyone who's using Bitcoin. Remember initially when Bitcoin first came out, all the mainstream media articles were super negative. It's like anyone who's using Bitcoin is a drug dealer, is a criminal. That was the type of mindset, the articles that were coming out. Now I would say things are changing. The perception of that, if you go and read a lot of the crypto articles, they're not like that anymore. Most of them are not like that anymore.
Oh, yeah.
But, if the governments do decide that, hey, too many people are going into crypto, too many people are going into Bitcoin, we don't care about the tax revenues that much, we want to implement our cashless society because, that rabble-rouser, they're speaking out against the government because, there's just so many... whether it's Tommy Robinson or Edward Snowden or Julian Assange, those are the rabble-rousers, and look what they did. They shut off their PayPal account, they shut off their bank accounts and their credit cards. I'm not saying every government's going to do that, but I know that some of them are at least contemplating doing it to a larger amount of people. In China, 15 million people recently were denied access to fly on planes and trains, and even worse is coming with their social credit score.
Yeah.
Well,
I completely agree.
Sorry to interrupt you. I think it's like a cat and mouse game between, the people who want choice and freedom, which is what Bitcoin gives people, and, in addition to paying with cash or saving in gold and silver, and then the governments want you to have no choice and no freedom, force you ultimately maybe to Fedcoin.
Right. Well, but it always has been. That's not new. I think we're not living in a period of change in government behavior, but what is new is that we have a way to opt out of that into a parallel system that the government can't control. They can tax it, but they cannot control it, and that is what is so special about Bitcoin. And I think a lot of the Austrian skeptics about Bitcoin have missed something pretty important, which we haven't talked about yet, which is that Bitcoin is not just a currency; it's also a payment system. So if you think about all the infrastructure that's invested in the payment system in the United States or around the world, all those point of sale swipe machines at the stores, all of the data centers that process transactions at Visa and MasterCard and American Express, all that infrastructure, you got to add all that up and add it to the U.S. dollar before you compare it to Bitcoin. It's not an appropriate apples to apples comparison to compare Bitcoin to the U.S. dollar. And that's what answers the regression theorem critique to me, because there is use value to Bitcoin. It's the payment system. And when Bitcoin was first created, of course, it wasn't money because no one was using it. But then everybody started using the payment system to confirm transfer of value transactions. And once people started using that, when I said everybody earlier, I said I really meant a small number of cypherpunks started using it. But once they started using it, and word got out to their friends, and they started using it, and then their friends started using it, that's when you actually saw Bitcoin become money. It wasn't money in the beginning. It was just a simple unit of account in a ledger that nobody had heard of. But once people started using that payment system for confirming transactions, that's when Bitcoin got its use value. And that is why it is actually backed by something. It's backed by its payment system.
And in a lot of countries, like I've seen documentaries on this recently in Japan and South Korea, that a lot of people think it's cool to pay with Bitcoin. So maybe not necessarily in the US, but at stores, at bricks and mortar stores, but you are starting to see at least some adoption. I think it's going to take some time. I know for a fact, though, because I've interviewed Perry-Ann Boring at the Chamber of Digital Commerce, that a lot of large technology companies, they're not immediately implementing blockchain technology into all of their software, but they are going to, over the next 10 years or so, be replacing a lot of their back-end systems with blockchain. So that's going to be, I think, there's a lot of critics out there on Wall Street who are saying that there's no use cases for Bitcoin and blockchain yet in the real economy, but it takes some time for larger technology companies to implement this. So I think the future is going to be very interesting, especially with smartphones. I mean, smartphones make paying with Bitcoin a lot easier than if we didn't have smartphones. So I think, Bitcoin makes paying with tablets and smartphones a lot easier. Even the banks are innovating now. Have you seen the Zelle payment system? So I think, this Zelle payment system, I don't know if it's blockchain, but, this is an innovation here that before Bitcoin and blockchain, the banks, I'm sure they had the technology to roll it out. They just chose not to do it. And now they're offering like digital transfers from one bank customer to another with little fees and almost instantaneous.
Right, but that's not running, to my knowledge, on a blockchain back end. That's just running on updated traditional centralized infrastructure as a back end.
But I think but I think Bitcoin and blockchain are forcing innovation, though. So I think the banks are starting to lose market share.
Yeah. Oh, I completely agree with that. It is forcing innovation. It's causing everybody to ask the question: why on earth is it okay that it takes 5 days to move money between the United States and Thailand? Why on earth do we accept T+2 settlement in the securities markets? Absolutely, it's causing a lot of conversations about why we have these crazy systems.
Or if you're working here in the U.S. and you want to send money to another country, go to Western Union and they charge you, 10% of what you're sending?
Yeah.
So the remittances, there's a lot of money made by middlemen on that remittances.
Oh, yeah. And I think, back to your earlier point about Bitcoin being used for retail payments, I think Bitcoin probably itself won't be used for many retail payments because it's not clear at the point of sale that Bitcoin is as easy to use. It's not as scalable. It takes 10 minutes to get your first confirmation. So, the cash and carry retail stores are probably never going to use it. Online, you can wait for confirmations to come back, but it's going to be second layer solutions that are built on top of Bitcoin that are ultimately used for payments. I think the traditional Bitcoin network, as we know it now, is going to be used for large value payments, but the smaller retail payments will be done in second layer systems like Lightning Network.
That's a good point. Yeah, I've been kind of trying to keep track of Lightning Network. I'm cautiously optimistic about it. I know it went live a few months ago, so we'll see. I think only about $50,000 worth of real Bitcoin is being tested on there right now, so it's not a large sum.
Yeah, but by the way, nobody should be surprised by that. It's new technology, and technology needs to be tested and tested and tested and then tested again. before it gets rolled out. And that's going to keep happening. I love the fact that it was rolled out in the Litecoin network before it was rolled out by Bitcoin, because it had the ability to prove itself outside of Bitcoin. And that's how I think about these altcoins, that some of them may turn out to be that far superior to Bitcoin. They may be able to build the network effects, but I doubt it. The Bitcoin is just so far ahead, and any innovation like Lightning Network can get adopted in an altcoin first, and if it works, then the Bitcoin core developers will add it to Bitcoin later. But they have the benefit of watching everything else as a test environment for them.
Or Litecoin could be used for small transactions and at retail, and maybe micropayments for content online or stuff like that. And then Bitcoin's used for large transactions. I know Charlie Lee of Litecoin was, I think, the first to do an atomic swap, right, with Litecoin to Bitcoin. So he's pretty innovative in the community.
Yeah. Oh, yeah. Yep. Oh, indeed. Yeah.
Well, Caden, I really enjoyed our discussion today. You know, I'm really hoping. I don't know if you've heard Ron Paul talk about competing currencies. So I'm in the, rather than a back to a gold standard or a bimetallic standard, I'm in the camp with Ron Paul that, ideally as a libertarian, I would like to see competing currencies. So let the market figure out what's best for which transaction. So maybe in a marketplace.
That's the Mangerian view. Yeah.
Mm-hmm. Yes, so that would be in an ideal world for me, where maybe there's a world for a number of different cryptocurrencies for gold and silver that you can, like with gold money, where you could just pay with a gold-backed debit card and stuff, and you're not forced to use legal tender laws with government fiat currencies.
Yeah. I mean, that's we have those alternatives already today. You're not forced to use the fiat currencies today. Those alternatives exist. They're called cryptocurrencies, and they're out there. And if you go to the state of Wyoming, you won't pay taxes on them.
Well, I was going to say you're forced to pay your taxes in fiat, right? So you have to pay your taxes in fiat. But yes, I guess you could transact in Bitcoin or other forms of currency if you want to right now.
Yeah, but what's interesting in the area of monetary laws. So Wyoming has been one of the states that enacted legal tender laws recognizing gold and specie as legal tender. So in theory, you could pay your taxes in gold or specie, gold or silver, in those states that have recognized those as legal tender. And I think now there are about 15 of those. No state has yet recognized cryptocurrency as legal tender. That's what we're proposing in Wyoming for next session, but a number of states have proposed being allowed to pay your state income taxes in cryptocurrency. In Wyoming, we don't need that because because there's no income tax in Wyoming. But there are states that are proposing to allow payment of taxes in cryptocurrency, which is effectively the same thing as allowing the cryptocurrencies to be considered legal tender. So there's been a really interesting regulatory movement that's been touched off by cryptocurrencies in terms of state legal tender laws.
And unlike a lot of people who are very anti-Bitcoin, anti-cryptocurrency, a lot of U.S. regulators, in whether it's the SEC, the CFTC, they don't want to kill the innovation in this new industry. So I think, I agree with what you said. I don't think they want to kill it. They just want to tax it and regulate it right now. That's the mode that they're in. Because they see this as a whole new industry with a whole new source of tax revenues, with new companies and, maybe new trading platforms and stuff. So that's a lot more money potentially coming in to the government.
Yeah, for sure. Yeah.
Not that I want the government getting more money to grow itself, but that's I don't want them killing new industries.
Yeah, well, and unfortunately that has been the case so far in blockchain. The U.S. is actually one of the least friendly regulatory environments for blockchain in the world right now.
Yeah, that's because there's so many different regulatory agencies, and then you have to do it at the state level. At the federal level, there's at least 5 or 6, and they all view I've interviewed Perry Ann Boring about this, and one of the regulatory agencies says it's a currency, another says it's a commodity, another says it's an asset. It's labeled as all these different things by different government agencies so they can regulate it, and then you have to comply with all of them. And so if you're a blockchain technology company headquartered in the United States, you're looking at like basically $2 million a year in just regulatory compliance fees. I think it's a ridiculous number.
Yes, there's no question that it's let's put it this way, the lawyers are making a lot of money off of advising companies in this space right now.
The lawyers win no matter what.
Yeah.
You worked on Wall Street, you know that with initial public offerings and mergers and acquisitions, the lawyers figure out that some of them bill at $1,000 an hour. Well, Caitlin, I want to thank you again for your time. If our listeners want to follow more of your work and keep up progress on Wyoming's blockchain integration and their laws, how do they do so?
Follow my blog, caitlin-wong.com, or I'm very active on both Twitter and LinkedIn.
Excellent. Well, thank you for your time. And I hope that Freedom and Bitcoin and the regular cryptocurrencies win this race, and that we don't see, Fedcoin and the People's Bank of China, Bank of England, Canada, the European Central Bank win this with their rollout, of the government crypto.
Yep, indeed. Thanks so much for your listeners, and check out my Mises speech, especially if you're interested in looking at some of the charts to back up the conversations we had earlier. Thanks so much.
Definitely. And I'll have an interview, and I'll have a link to the interview in the information section of the interview. Okay. Thank you for your time, Caitlin. I appreciate it.
All right. You're welcome. Have a great evening. Thank you.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website, and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.